Welcome to the deep dive. Today we're tackling a financial reality that's, well, it's becoming more and more common, but we rarely talk about it head on.
Mhm.
How do you build a secure, an adaptable financial safety net for your family when your obligations are stretching across continents?
Right. And you're navigating different currencies, different rules, and honestly, immense family pressure.
Exactly.
And that dual challenge, securing your foundation here while managing all that global complexity, is exactly what our sources get into.
Yeah.
Our study today is to move beyond the generic personal finance advice.
Right.
We're pulling together the actionable strategies, the essential mindset shifts you need for saving, especially when you have large remittance demands, and this is critical, how to leverage global opportunities without falling into the compliance traps. We're here to give you that shortcut to being well-informed.
Okay, let's unpack this. We have to start with the foundation, obviously, but let's frame it immediately through that lens of complexity. For families dealing with global finances, the first big shift isn't just about, cutting expenses.
No, not at all.
It's moving from short-term financial firefighting to intentional, consistent, long-term action. You almost have to treat your family's financial future like a business plan.
Absolutely. And the very first intentional action is moving past just knowing you should budget to actually doing it, to creating a realistic, dynamic family budget.
Because for anyone managing money in 2 or 3 different places, the goal isn't restriction.
It's informed choice.
Yeah.
You need a forensic understanding of where every single dollar or pound or peso is actually going.
And when we say tracking, we mean really drilling down beyond just the big bills. I mean, of course, you map out the rent, the mortgage, the childcare.
All the usual suspects.
But for listeners balancing these obligations across borders, you have to track those other costs. The irregular wire transfer fees, the cost of flights home, the exchange rate swings that suddenly make a tuition payment more expensive.
That level of detail, it really requires tools. This is where technology is such a massive advantage. Using apps like YNA or Emma, or even the features inside your own banking app, it lets you automate all that categorization.
So you're not sitting there with a spreadsheet every night.
Exactly. It changes the whole behavior from manually logging everything, which is tedious and people just abandon it, to simply reviewing and adjusting. You're basically outsourcing the discipline to the tech.
So once you have that detailed picture, the immediate priority becomes the emergency fund, the EF.
Right.
We hear that term all the time, money for financial distress. But for a global citizen, the EF serves an enhanced function, doesn't it?
It really does. It's more like an international buffer. The target is still 3 to 6 months of essential living costs. But for someone supporting family abroad or living in a new country, that fund protects against so much more than just, say, losing your job.
It's guarding against a sudden currency devaluation.
A huge currency swing, yeah, or unexpected repatriation costs, or maybe even a lapse in your visa status that cuts off your income.
And the sources really emphasize that for expats, this is paramount because they often don't have that local, informal safety net, family or friends who can bail them out of a sudden crisis.
Precisely. Now, if you're building this from scratch, you can feel huge. That 3 to 6 month number is daunting.
Yeah, absolutely.
But the strategy is to start small and just automate. Even setting aside the equivalent of, say, £10 or $20 a week and automating that deposit on payday,
Yeah.
it just eliminates the temptation to spend it. We're leveraging consistency over big amounts.
And that automated consistency, it brings us right to the concept that seems to separate successful savers from everyone else.
Pay yourself first, PYF.
Right.
This is essentially behavioral economics applied to saving. It's the reverse budgeting model. So instead of the classic way income pays bills, pays for wants, and then you try to save what's left over.
If there's anything left over.
Right, if anything's left. PYF flips that. It forces you to divert money to savings or debt payoff the second you get paid.
But why is that so critical? I mean, if I'm a disciplined person, shouldn't the old way work just fine?
You might be disciplined, but our brains just aren't built for constant self-control. There's this idea, Parkinson's law for money, that expenses will always expand to fill the money available.
Okay, I can see that.
If you see that money in your checking account, you're psychologically wired to find a use for it. PYF just harnesses inertia. You set up the automatic transfer, and the money is gone before your spending brain even knows it was there. It removes that reliance on daily discipline.
Okay, so let's get into the mechanics. Based on the sources, what's the right allocation?
You always calculate it based on your net pay your take-home after taxes. A common guideline is to aim for somewhere between 10 to 20% of that paycheck for savings or debt repayment.
And that often lines up with the 50-30-20 rule we hear about.
It does. 50% for needs, 30% for wants, and that crucial 20% for saving or debt. But we have to acknowledge for a lot of our listeners that 50% needs bucket might be way bigger.
Because of remittances or an international mortgage.
Exactly. They might be operating on more of a 65-15-20 split. The core principle doesn't change, though. That savings percentage, whatever it is, has to be automated first.
That brings up a huge point of conflict in financial advice. Do you save first or do you kill high-interest debt first?
And that's a genuine trade-off. Mathematically, paying off high-interest debt like a credit card is the highest guaranteed return you can get. The interest you save is money you've earned.
So why not just do that?
Because you need a security blanket. The consensus for a resilient path is this. You have to establish that minimal emergency fund first.
Get the 3 to 6 months squared away.
Yes. Get that cash buffer in place. It ensures you don't fall right back into high-interest debt the second you get a surprise car repair bill. Once that cushion is there, then you pivot aggressively to debt, and only after that do you focus on long-term goals like retirement or education savings.
Okay, shifting gears a bit, from personal discipline to the immense family pressures that often define this whole situation, let's talk about managing those global family obligations.
We have to start by saying one of the greatest things you can remit isn't actually money. It's financial literacy. Teaching kids about money by, giving them a small allowance, letting them compare prices, letting them manage their own birthday money. That's a legacy that transcends any currency.
And that becomes so vital when we talk about the pressure cooker that people like, say, overseas Filipino workers face. They're balancing their own survival with these huge, immediate family expectations.
It creates this incredible tension. And the key advice from people who've done this successfully long-term is that the sender must stick to that pay-yourself-first rule. You have to treat your own emergency fund contribution like a mandatory bill.
You're securing your own oxygen mask before assisting others.
Exactly. And that might mean starting small, maybe just 500 pesos a paycheck into your own safety net, but it has to be consistent and it has to be untouchable because that income stream providing the remittances is often temporary. It's subject to all kinds of risks.
The sources break this down into 3 phases for the family that's receiving the money, which really highlights why the sender needs to have firm boundaries.
That's right. The first phase, the short term, is usually debt-dominated. It's all about paying off the loans for migration. Then you move into the medium term covering household expenses, maybe some home improvements.
Okay.
But the critical phase is the long term. This is where the money is supposed to transition into real investment, funding an asset, a business, or the sender's own retirement.
And the big warning is that the receivers often miss that transition. They start to see that medium-term support as a permanent income stream.
It's a huge psychological hurdle. And this is where setting financial boundaries moves from being a good idea to an absolute necessity. When you're the sole provider, the guilt can be paralyzing.
So how do you manage that?
The recommended reframing is really powerful.
Yeah.
You shift your perspective from seeing the support as this inescapable burden to seeing it as a privilege that you have earned the right to provide.
Within your means.
Within your means, exactly.
That helps with the emotional side, but practically speaking, how do you enforce a boundary without causing massive family friction?
The key insight here is realizing that a boundary is about your actions. It doesn't require their agreement or participation. You set the boundary based on your budget, your reality, not their emergent need or emotional pressure.
So if your budget allows for $500 a month, that's what you send, even if a relative asks for $1,000 for a car repair.
You send the 500 consistently, and you communicate your commitment to the long-term plan, not just the short-term request.
Before we jump into global investing, we need to touch on the legal groundwork, the safeguards you need when life, throws you a curveball.
This is just pure due diligence. Organizing the paperwork. That means getting life insurance to protect your dependents. It means establishing a will, a comprehensive one that names guardians for your kids and outlines how assets are distributed across different countries. And those documents have to be accessible.
And what about planning for incapacity? The documents that kick in if you can't make your own decisions.
You need 2 specific types of power of attorney. A durable financial power of attorney is critical. It gives a trusted person the authority to manage your finances, pay bills, access accounts if you're incapacitated. That's vital if you're managing assets and family care from a distance.
On the second one?
The healthcare power of attorney. It designates someone to make medical decisions for you if you can't. Understanding the difference between those two is just non-negotiable for family security.
Okay, so the foundation is strong, the legal side is sorted. Let's talk about leveraging global growth. This is where the data gets, well, pretty startling. High-yield savings accounts in emerging markets.
HYSAs.
Yes.
They're getting a lot of attention because they offer much higher returns than what you'd get from most Western central banks right now. Plus, you get some currency diversification. We're talking about returns that can be double, even triple what you'd get at home.
Can you give us some concrete examples?
Sure. We've seen places like Georgia offering local currency rates between 10 to 11.25%. Armenia has been consistently around 10.5% in their currency, the dram. Mongolia has offered up to 12.4% in the tugrik. But, and this is a huge but,
There's always a but.
those rates do not come risk-free.
Okay, that's the conversation we need to have. What's the trade-off? What are the warnings?
The trade-off is often volatility and inflation risk. A country can offer a 12% deposit rate because their domestic inflation is also very high. And more importantly, for anyone holding dollars or euros, that amazing 10% local return could be completely wiped out if that local currency devalues by 15% against the dollar.
So you have to factor in the currency risk.
You have to. And there are other risks too, liquidity constraints, sometimes political or regulatory risks, the chance of capital controls where a government suddenly restricts money from leaving the country. It's not common, but it's a possibility you have to weigh. These accounts require active, informed risk analysis.
So for people who are consistently transferring funds, either for remittances or to these accounts, let's talk about efficiency. How do comparison databases help?
Remittance price comparison databases, often sponsored by groups like the World Bank, are vital. They create transparency. They force providers to clearly show you the two cost factors, the flat fee and the hidden cost that's baked into the exchange rate spread.
And we have hard data on the impact of that transparency.
We do. In the UK, when these tools were implemented, transfer costs dropped significantly. On certain routes between 2005 and 2009, average remittance costs fell by about 48%. Competition helps the consumer, but only if you use the tools to compare.
Finally, we have to spend some real time on compliance. For any of our listeners who are considered U.S. persons, the FBAR filing requirement is. It's absolutely crucial.
It is non-negotiable. This is governed by the Bank Secrecy Act. Any U.S. person that's a citizen, a green card holder, or a domestic entity, has to file FinCEN Form 114, the FBAR, if the aggregate maximum value of all their foreign financial accounts exceeded $10,000 at any point during the year.
And it's that aggregate maximum value that trips people up. So if you have 3 foreign accounts and their highest balances combined, even for one day, tipped over 10 grand, you have to file.
That is exactly right. And we need to be clear about what counts as a foreign account. It's broad. Bank accounts, securities accounts, even some life insurance policies with cash value, and foreign retirement accounts like a Canadian RRSP or a TFSA.
So if someone is just using a foreign bank account to pay local bills while they're living abroad, they are very likely to hit that threshold.
Absolutely, even if the money is just passing through. One quick note on crypto. Right now, an account holding only virtual currency isn't reportable. But FinCEN has made it very clear they intend to change that, so that's a space you need to watch very closely.
What happens if someone realizes they should have filed, but they didn't?
The penalties are serious civil monetary penalties. However, if you're late, the best thing to do is file the late FBAR immediately and explain why it was late. If the failure to file was due to what they call reasonable cause, you might be able to avoid a penalty. But ignoring it, that can be financially catastrophic.
This deep dive has covered a huge amount of ground. We've gone from the psychology of paying yourself first, through the complexity of family boundaries and remittances, to the high-risk, high-reward world of global HYSAs and the absolute mandate of FBAR compliance.
We really aim to provide context, not just data. Financial stability, especially with these global ties, it's not just about accumulating numbers in an account. It's about creating flexibility. It's about ensuring freedom and building the confidence to support the people you love without sacrificing your own future.
We've established that building that secure foundation, that 3 to 6 month emergency fund, is the essential first step. And consistency is the secret sauce. So here's the final thought for you to chew on. If we know consistency is key, what is one small financial habit, beyond just saving, that you can automate today to guarantee your future self has the most freedom and the most options? Think about it. A small monthly transfer, not just to savings, but maybe directly towards your highest interest debt, or reviewing your tax situation, or automating a tiny microinvestment into a long-term retirement fund. That one small automated action is your greatest point of leverage.